Robert retired with $900,000 in his 401k, and for 11 years nothing unusual happened. Then he turned 73. That year his tax bill jumped, and he hadn't spent an extra dollar on himself. Roughly $17,000 of new income showed up on his return. It was his own Social Security, made taxable by a withdrawal the law required him to take. I've seen this catch careful people over and over. It doesn't find the retirees who overspent. It finds the ones who deferred the most for the longest and did it on purpose. Let me walk you through the rule and show you how someone in the 12% bracket ends up paying closer to 22. Most of us picture a 401k as a box with our name on it. The account is yours. Not every dollar in it is. Each pre-tax contribution came with a quiet agreement. The government skipped the tax that year in exchange for the right to tax the withdrawal later. Later, at whatever rate happens to apply then. So $900,000 is not $900,000 of spending power. It's a balance with an unpaid bill attached, and you don't set the due date. The assumption almost everyone carries into retirement sounds sensible. Less income, lower bracket. For many people, it works out that way. For steady savers, it often doesn't, because two things happen at once. The balance keeps compounding, and the code eventually forces money out whether you need it or not. So what exactly does it force? The rule is the required minimum distribution, or RMD. Under current law, at 73, you have to start withdrawing a minimum amount each year from a traditional 401k or traditional IRA. For savers born in 1960 or later, that age moves to 75 in 2033. Check which one matches your birth year. The amount is not a percentage you choose. You take the balance from the last day of the prior year. Then you divide it by a life expectancy factor the IRS publishes. At 73, that factor is 26.5, which works out to about 3.8% of the balance. The factor shrinks every year, so the required share climbs as you age. Every dollar is taxed as ordinary income, not at the lower long-term capital gains rates. Roth accounts work differently, and that difference matters in a minute. On its own, that's manageable. The trap is what the withdrawal runs into on its way through the return. Look at Robert's numbers. His $900,000 balance produces a required withdrawal of about $34,000. He also receives $30,000 a year in Social Security. Whether those benefits get taxed depends on a formula called combined income. It adds your other taxable income to half your benefits. Without the withdrawal, Robert's combined income would be $15,000. That sits below the $25,000 threshold for a single filer. None of his Social Security would be taxable. With the withdrawal, his combined income is $49,000. That drags about $17,000 of his benefits onto the return. A $34,000 withdrawal produced roughly $51,000 of reported income. Now watch what happens to the next dollar. In that range, each additional dollar he withdraws pulls up to 85 cents of Social Security along with it. Sitting in the 12% bracket, he pays tax on $1.85 for every dollar he takes. 12% of that is about 22 cents. His bracket says 12. His reality is closer to 22. Planners sometimes call this the tax torpedo. The thresholds that trigger it were written decades ago and never adjusted for inflation. $25,000 and $34,000 for single filers, $32,000 and $44,000 for joint filers. They catch more people every year. 2 years later, a letter arrives from Medicare. Robert's Part B and Part D premiums are going up. The reason is a surcharge called the Income-Related Monthly Adjustment Amount, or IRMAA. It's based on his income from 2 years earlier, which was the year of that first large withdrawal. The brackets work as cliffs, not slopes. Crossing one by a small margin raises his premiums for a full 12 months. The same withdrawal has now been billed twice, once by the IRS and once by Medicare. For married couples, there's a sharper version waiting. David and Susan are both 75 with $1.8 million across their accounts. Their combined Social Security is $60,000 a year. Their required withdrawals come to about $73,000. Filing jointly with the standard deduction, that keeps them in the 12% bracket. Then David dies. Susan keeps the larger of the two benefits, so household Social Security falls to about $36,000. She inherits the accounts, so her required withdrawal stays near $73,000. Her income drops by roughly 16%. Her top rate climbs to 22%. She files as a single person now, and the single brackets are about half as wide. Less money coming in, nearly double the rate on it. That's the widow's penalty. If the rule is fixed and the consequences are this predictable, where does the mistake actually happen? Years earlier, in the quiet part. Between the last paycheck and the first required withdrawal, most retirees pass through a stretch where their taxable income is the lowest it will ever be. And most of them guard the 401k and touching nothing. Then 73 arrives, the balance has never been bigger, and the withdrawals are no longer their call. Once you see it that way, the question changes. It stops being how much is in the account, it becomes which years you still have any control over. Ray is 62, newly retired, with $700,000 in a traditional 401k and no Social Security yet. On paper, he has almost no income. In practice, he has 11 years before his first required withdrawal, and the balance grows the whole time. At a modest 6%, $700,000 becomes roughly $1.3 million by age 73. His first required withdrawal would land near $50,000, needed or not. Those 11 quiet years are the only window where he picks the number himself. He can fill part of a lower bracket deliberately, converting to a Roth or drawing at a rate he can see in advance. None of that guarantees he comes out ahead. It turns on future tax rates, his spending, his health, and who inherits the account. What it does guarantee is that the number was his choice.
So, how do you tell whether this applies to you? Project your traditional balance forward to age 73, using a growth rate you consider reasonable. Divide that projected figure by 26.5. That's a rough first required withdrawal. Add your expected Social Security, any pension, and any interest or dividends. Find the bracket that total lands in and set it beside the bracket you're in today. If the future one is higher, you've found the gap worth planning around. From there, the questions are specific enough to bring to a tax professional. How much can I convert or withdraw this year before crossing the next bracket or the next Medicare threshold? Does my state tax retirement income? And who inherits this account? Most non-spouse heirs now have to empty it within 10 years, often during their own highest earning years. The hidden tax trap in a 401k is a timing problem wearing a tax problem's clothes. You chose the year the money went in. The code chooses the year it comes out, and it chooses late, when your income is stacked and your filing status may have changed. Knowing that won't guarantee anyone a smaller bill. It gives back something narrower and more useful, which is the chance to decide in advance. Robert's $17,000 was never unavoidable. It was only unplanned. And a 12 that behaves like a 22 stays hidden until somebody runs the number. If you want more of the rules that tend to surface too late to act on, subscribe.